Well, Tim, welcome. Thanks for joining us.
Yeah, thanks for having me. Excited to be here.
Yeah, and we're excited to have you. And before we get started, talk to us about the new role. I think you started in a new capacity, a pretty significant move in March, if I'm not mistaken.
Yeah, it was just announced starting in June here at CME Group. I'll be taking over an expanded role. I'll be running all of our financial product portfolio and OTC products at CME, which include equity indices, foreign exchange, interest rates, as well as our cryptocurrency and our OTC product line, as well as our cash markets for EBS and US broker tech, which is really exciting. I'm super excited to take it over. I've been at CME just over 10 years now. I joined the management team last March, just a little over a year ago. Really looking forward to the expanded opportunities. It's an exciting time for sure to be at CME. With everything going on in the markets, there's no better place to be.
No, no question about it. We talk about it, a lot in terms of what we're seeing. And if you think about forget about the last few months, over the last 18 months to 2 years, if you think about the moves we've seen in markets, largely predicated on central banks, specifically our Federal Reserve, all roads lead back to CME Group and the products that you guys and gals trade. So, just on sort of a 30,000 foot level, what's been really busy? Obviously, we've seen a big move in Bitcoin over the last couple months, but what sort of captured the fancy of a lot of your client base?
Yeah, I think it's a great question. And I think what's interesting is when you look at not only say the last few weeks, but almost the last few years, but certainly accelerating the last few weeks and months, is risk management is becoming more and more important as more and more uncertainty creeps into the market. It seems like everywhere we turn, new things are happening, market moving events, they're happening at sort of all hours across the globe. And that's something where we cannot overstate the importance of risk management. And as risk management needs are elevated in this environment, it's important in this environment of mixed signals that market participants have to hedge. I mean, we can't say that enough. Like risk management is almost the new alpha, I think, in this market, and the importance of hedge and maintaining those hedge is of more and more importance. And what better place to do it than the CME? CME is the world's largest venue to manage risk. We have all the major investable asset classes. We have cryptocurrency. We have futures markets, options on futures market, cleared OTC market, cash markets. The availability of CME to offer risk management tools to our clients is unmatched, unprecedented, and is becoming more and more important every day. Let's just look at Q1, for example. When we look at some of the volumes we've seen over Q1, record interest rate volume in Q1 at CME with 14.5 million contracts. And when we look at some of the volume that we saw across the exchange, about 26.9 million contracts. That was our second highest quarter ever in terms of exchange volume. So the volume is sort of keeping in line with these risks manifesting in the market. And that's where more and more people are continuing to turn to CME in these unprecedented times.
Yeah, and if my sort of spidey sense is correct, that trajectory I think is going to continue because I don't see any. Let's put it this way: I think this environment's going to continue a lot longer than people realize. And you set us up for really the first really important question and something we've been talking about for a while. Obviously, Terry Duffy is a friend. Terry's talked about using futures to hedge and the importance of it. But sometimes those are just words. In real world, though, something recently happened in the form of Silicon Valley Bank. Now, understanding you don't have access to their portfolio, so you can't speak that granularly. I've submitted, Terry has said this as well, and I'm sure you feel this way, that if Silicon Valley Bank had hedged their portfolio, had hedged their duration risk, yeah, there would have been a problem, but not nearly to the extent that we are obviously talking about and seeing over the last month and a half. So maybe speak to us as to how Silicon Valley potentially could have used futures to hedge that duration portfolio.
Yeah, for certainly. I think when we don't have, insights into the exact portfolio they were holding, as you mentioned. But if we just even look at some of the information that we've learned over the last few weeks and what's publicly available, is we saw that a hedging strategy for interest rates could have been helpful in this scenario. Could have helped them where it seems like SVB sort of almost doubled down on the U.S. Treasury exposure they had. Where when we look at some of the reports, they took in tens of billions of dollars in terms of deposits. They invested a lot of that in the longer term US Treasury bonds. And this, all sort of makes sense in its own right. But the issue is, was it hedged? And I think when you look at sort of entering into some of these hedge transactions, that is what can be protective. Now, to your point, it can't always completely inoculate against the risks that are out there in the market that might manifest it, but it could certainly help to mitigate the risk that might manifest. And I think when you look at some of the other events over the last few months, yeah, certainly there were perhaps aggressive Fed rate policy that in the hikes that took place, but those necessarily weren't surprising. I think a lot of people expected upward rate movements from the Fed. But when you look at that coupled with, we learned that the chief risk officer position was, I think, was open for almost a year, right? I mean, this is something where it comes down to like sound risk management practices need to be in place. And when you look at the uncertain environment, you can again mitigate some of it by just entering into that hedge trade. So if you look at this, you could have just sold some US Treasury futures. So when the rates are rising, the bond portfolio price drop would be partially, or if not all, offset by a gain on the futures position. I mean, this is sort of hedging 101 when you get down to it. And it's very surprising to see that in this market, people still are not necessarily hedging their portfolio in the manner in which they should.
Now, I would submit, and I don't know this obviously, I can't speak specifically about Silicon Valley Bank, their lack of a chief risk officer, which I think has been documented, or any of those things. But why do you think, again, not Silicon Valley specifically, but the industry in general, people are reluctant to do that, or they just don't understand it, or even probably more probable, they haven't had to because things haven't moved. So speak to that. And then obviously some of the educational services you provide that can get people up to speed.
Yeah, I think that's a very interesting point. It's something that I talk about with the team at CME. For background as a reminder, before joining the exchange a little over 10 years ago, I was an equity index trader on the sell side. I was at JP Morgan and RBS. And I think some of it is almost generational when you think about it. These are market moving events that traders haven't seen, that investors haven't seen. They're used to prolonged bull markets in equities, they're used to zero interest rate policy. They're not necessarily used to the pace of change that we've seen from the Fed over the last several cycles. So I think some of it is familiarity. And we can't stress enough that hedging and risk management is the cornerstone of good financial strategy. When we look at it, these are known risks, or you could deploy certain strategies to help mitigate these risks. And a great place to learn more about it, particularly those that might be sort of first time traders or smaller institutions, or they're trying to figure out, or they may be a manager trying to ask sort of their risk management people what are the things they should be thinking about. CME Group has a ton of tremendous resources on the educational front. We're not only sort of focused on developing the most liquid markets for our futures and option products at CME. We really want market participants and investors to understand the market fundamentals and why they should hedge. And CMEgroup.com is a great resource for that. We have tons of educational content, videos. We work with a lot of partners in the industry to get the content out there. And I can't stress enough that educational material is so important to consume because it really spells out those fundamental risk management principles and doctrines that people should have on the radar, whether they're managing risk or conversely, if they want to sort of deploy trading strategies that might be opportunistic in these times. When we look at the individual investors or even some of the other various market participants out there, not everyone necessarily needs to be hedged. People look and try to take trading opportunities. They're looking to deploy certain trading strategies to take advantage of some of these opportunities. But you can also do that in a very prudent, thoughtful, balanced, managed way by using futures, having sort of controls and risk management tools embedded in those strategies, even if you're trying to take advantage of some of the market opportunity. And again, there's lots of great resources for understanding all of the strategies that can be used with futures and options at CME.
It's interesting. There's obviously two facets of this. It's as hedges, they're extraordinarily, I think, important to your earlier point, and people just need to get up the educational curve and the understanding curve and to realize why they're so important. And maybe, listen, quite frankly, maybe they haven't been necessarily over the last decade or so, given the fact that interest rates really didn't move in a precipitous fashion. The world has changed underneath everybody's feet. My sense is, though, these are directional plays as well that you can utilize. And I think for the individual investor, the individual retail trader, these could come very attractive. But small business is something that we probably don't talk about enough. But if you think about the risks associated with owning a small business, interest rate risk has to be at the top of the list. So even for a small business to mitigate some of their variable rate exposure, I think CME Group would be a wonderful resource. Maybe you can speak to that. And is that something that makes sense?
Absolutely. So I think when we look at the varying size of participants that exist in the market, while they may have similar needs or similar risks, sometimes the magnitude of those risks vary just as a function of what type of participant they are, whether they're a large pension fund or a small business. We have tools for everybody here at CME in terms of managing that risk. And if you think about maybe that small business community or even that individual trader, I think one of the things that is exciting is the success that we've had in the micro size products at CME. Those are things that we really started to ramp up in 2019 with the micro e minis. But we also have a micro treasury yield contract, where it's that smaller size contract. It's $10 per basis point of yield. It's quoted in yield terms, so it's much more in line with the colloquial way people talk about rates, and they sort of know what their rate exposure is. If you're thinking about the way maybe their credit line works, if they're a small business, or some of the financing they have in place. And they're those still small, precise contracts, deeply liquid, based on all sort of the same market structure as their older sibling benchmark products. But we have sort of the older sibling size and the micro size, so there's one size for everybody as they need to manage very similar risks. And I think when we look at the simple contract design and the smaller size complement that these are when looking at sort of the more deeply liquid US Treasury futures and options at CME, it's really the combination of these tools that make it so powerful, because you have some of those larger traditional institutions trading the larger size contract and then availing that liquidity in a very similar fashion to the smaller size contracts. We see that sort of across the board, and that's something that is unique to CME in our ability to offer it. They can lean on the benchmark and just focus on getting the right sized contract to that market participant. It's not necessarily a different, typically or totally different idiosyncratic market structure. It functions the same way. It's really just the size that is different, which I think is a unique and compelling element that everyone should look at if they're looking to manage some of their interest rate risk.
And I want to touch on that in a second, but the thought, again, I've had many conversations with Terry over the years, and one point that he'll make pretty consistently is, if you're living in this society, if you're a citizen of the United States, or effectively a citizen of the world, you'd be surprised at the amount of touch you have with CME products, specifically, obviously, with interest rates, with mortgage risk, and those types of things, but across a variety of things, from commodities to precious metals to a number of different things. But, if you remember maybe 10, 15 or so years ago, the standard for a lot of people were adjustable rate mortgages. I think the thought being that over a 7-year course of time, rates weren't going to move that much on them. And if they did, it wouldn't be in a precipitous way. But we will probably rotate back to that at some point. But if people are listening to this now, I mean, there's a really interesting way, I believe, that if rates were ever attractive enough where you could put on an arm, you could effectively hedge your out year risk with the products you trade. Does that make sense?
Yeah, absolutely. Now, you sort of have to sort of always adjust, or there'll be a little bit of proxy, sort of the positions that you're putting on. But directionally, that's completely accurate. When we think about the risks that manifest in our own day to day life, whether that's our mortgage, whether that's our retirement savings or our pension plans on the equity front, these are all things that CME helps provide those wholesale institutions the ability to offer those products to the individual participant at the consumer level. But conversely, we also can help the consumer hedge against those risks themselves. You don't necessarily need to be sort of naked these risks, so to speak, in your every day to day life. You can hedge them. And we have the contracts of various sizing at CME. And again, but it really will come down to making sure that you precisely understand the risk you're looking to manage so you can deploy the right strategy, whether that's using the micro yield future against maybe your home mortgage, or we also have TBA futures at CME, whether you're looking to hedge some of your retirement savings using equity e-mini contracts. You can maybe sell some of those contracts if you think the market's going down and you want to protect some of that retirement balance. These are all things that people could use in their day-to-day life, but I don't think people understand, to your point, the totality of how CME touches these things. When we look at food, when we look at fuel, when we look at your equity portfolio, your interest rate exposure, these are all things that manifest in the day-to-day life, and they're easily hedgeable. These are things you can hedge if you understand how the products work. And then to our earlier comments, just extrapolate that upwards. It is surprising when you still see institutional traders not managing risk precisely, not hedging. I mean, this day and age, I mean, that's just a strategy that you can't really endorse anymore, is not being on top of risk management. And we would certainly encourage the individual traders to take that same mindset. Hedging is easy, and it's a very required and essential tool in your portfolio these days.
I watch the reports, the earnings reports that come out, and I don't scream on television because it doesn't do anybody any good. But I will tell you, in the sanctity of my basement, I absolutely scream. So when companies talk about missing earnings on the back of foreign exchange moves and that types of things, I'm saying, are you kidding me? There are instruments with which you can hedge your portfolio risk specifically for foreign exchange, and I'm sure when you have meetings, you probably talk about these things. What are the barriers of entry? Why are people reluctant to the extent that they are to go down this road? Is it just understanding or is it something more?
That's something that we certainly look to dive into all the time as we're trying to figure out how to continue to grow our business. How do we continue to attract new participants to our market? And I think sometimes it's a combination of a few things, but it really comes down to, I think, education, familiarity, making sure they're aware of the products and understand how they work. But then when we look at things like FX, or if we look at sometimes in the equity markets, sometimes they're familiar with other parts. They may be trading spot FX, they may be trading maybe single stocks or ETFs. So it's also working with market participants to further increase their product knowledge, that they can do these things on a forward basis. They could use futures to hedge things further out the curve, even if they're familiar with how spot markets work. To use your point, if you're that multinational corporation that has diversified currency inflows, you're sort of attuned to maybe managing those balances. But yeah, to your point, it's like, just take the next step of hedging it out in this environment. We've seen the return of volatility in the FX market. We've seen that exacerbated by the disparate policy between the various central banks across the globe, where last year, as we headed in from Q3 to Q4, we both saw pretty significant appreciation and depreciation of the dollar against other major currencies across the globe. So it's also moving not in one way, but in different ways, depending on what's going on with respect to the macroeconomic policy that's out there. So yeah, I mean, it is shocking, if I'm being honest, to see that people still don't hedge in this environment, but it's very easy to do so. We require a futures account. CME is a regulated venue. We're a trusted venue. I mean, for those out there that maybe don't even know, CME is nearly 180 years old. We have a very trusted and tested relationship with markets, where we are the center of price discovery and risk management for a lot of these products. So this is what we do, and we're really just here to help people understand how can we help them manage their risks, regardless if they're on the smaller end or on the much larger end. We're here to help, and it's very easy to implement these type of tools into your portfolio. And the old adage is, things are going fine until they're not, right? And you cannot wait until sort of you're in a crisis moment to figure out what your hedging strategy is. You need to be proactive about analyzing your portfolio and making sure you have these tools at the ready should you need them.
It's interesting. I think for many people, even savvy market participants, they view futures as a speculative tool, which they are at times. They can also be their own asset class. Is that true? Because I think, if in fact it is, I think people are going to start to come to that realization rather quickly.
Sure, absolutely. I mean, when you look at markets in general, not even for futures, but even if we look at some of the cash markets, there's going to be an element of speculation. And that is sort of required to get the market to move. When you think about it, if everyone had a universal view on what the risk was, you would have a one sided market, everyone wanting to trade the same way, and no one willing to take the other side. So, well, sure, we'd love to find those natural offsetting buys and sells who have natural diametrically opposing risk viewpoints, but sometimes you need people to come in speculating on what the market might do next to help transfer that risk amongst the parties who are looking to hedge their natural exposure. So that's not something unique to the futures market. You're going to see that, I think, in most capital markets, if not all of them, there is always going to be an element of speculation coupled with liquidity provision, as well as sort of varying degrees of market quality depending on the personality of that market. But speculation is sort of a key component of the price transfer process, and they're the ones willing to step up and provide that ability to transfer the risk because they might have a different view on where the market might go on subsequent ticks or in the short term. So that's certainly something that we see. But I think sometimes it just gets a little bit of a bad rap where people misunderstand sometimes that speculation helps the naturals find each other. So that's always a great part of the market. And then I think when we look at sort of futures more broadly, I think they're immensely useful in terms of what they do with respect to going further out the curve. And if you're not thinking about them from a trading perspective, where they could be also immensely helpful is just from a pricing perspective. When you look at some of these markets, you can have a market determined view based on where people actually have bought and sold contracts, where they've agreed to transfer risk at a future date and time. It could be 2 weeks, it could be 2 years, 10 years out in time, and the market will tell you is this is what is believed to be the price at that future point in time. And that's highly informative with respect to where the risks might be manifesting as a function of time. So even if you're not sure you should be trading futures yet, you should certainly be looking at futures market because they will help you keep informed about what the market is going to think is going to happen and whether or not that jives with your understanding.
Tim, we'll have you back to talk about contango and backwardation. But in the meantime, best of luck in the new role. It's tremendous. You're going to do great things. And thank you for joining us here on the tape.
Thanks again for having me, and look forward to being back on the show.